Assalamualaikum warahmatullahi wabarakatuh. Good morning, everyone. We are from the group 2. This time we will explain the material about earnings smoothie and earnings management. Okay, before we start to explain the material, let me introduce our group member. The first is Velisa Enjjelita Sandi with three last ID number is 038. Next is Aulia Puja Dewanti with three last ID number 100. Next, Rara Wiritanaya with three last ID number is 112. Next is Syifa Novia Suryanti Putri with the three last ID number is 147. And the last but not least, Sandi Bagas Permana with three last ID number is 403. Okay, thanks for the time, moderator. This time I will to explain about defining about the earnings management. Earnings management is a managerial action in preparing financial statement and at influencing reported earnings in the short term without altering the company's underlying economic condition. Haley and Wohlen in 1999 defined earnings management as the innovation with specific intention in external financial reporting with the aim of obtaining personal advantage. This practice is carried out within the flexibility permitted by accounting principle, but often result in deviation from the information that should be truthfully conveyed to a user of financial statement. Next slide is about objective and motive of earnings management. In earnings management may be conducted by company for various purposes, including first, bonus plan hypothesis is a manager tends to increase earnings so that the bonus compensation based on profit can be maximized. The second is about the debt covenant hypothesis to avoid violating debt agreement management attempt to present a healthier financial position than the reality. Third is about a political cost hypothesis about the large firm may reduce their reported earnings to avoid attention or interpretation from the government or the public. The fourth is about initial public offering or IPO. Is about the earnings management issues to make financial statement appear to attractive to potential investor. And the last but not least about taxation is about the lowering reported accounting earnings to minimize tax obligation. Okay, next slide is about the types of earning management. Earning management is generally categorized into two main types. First is about the accrual earning management. This is done by utilizing the flexibility in the choice of accounting method without affecting actual cash flow. Examples include is changing of the estimated useful life of asset, adjusting allowance for double account, and the last about the changing inventory valuation methods. And the second is about the real earning management. This involves steering operational decision or real transaction. Example include is cutting advertising or R&D costs on increased profit, offering large discount to boost end of period sales, and the last is about the delaying inventory process.
Okay guys, now I will explain about technique of earning management and detection of earning management. The first we want to talk about technique of earning management. So there are four techniques used in earning management include the first is income smoothing. This is maintaining earnings stability to avoid large fluctuation and improve investor perception. The second is big bet accounting. This is recognizing large losses in a bad period, making future financial performance appear better. The third is cookie jar reserves. This is increasing reserves during high profit period and reducing them during low profit period to maintain stable earning. The last is changing accounting policies. This is changing accounting methods such as depreciation or revenue recognition method. And next we want to talk about detection of earning management. So earning management can be detected using various accrual models such as the first is Jones model at 1985. This is estimated total accruals by controlling for the effect of change in sales and fixed assets. The second is modified Jones model at 1995. This is a modification of the Jones model that eliminates the credit sales component for more accurate result. And the last is cash flow approach. This is analyzes the deviation between operating cash flows and net income. Now I will explain about impact of earning management. So there are two impact of earning management. It is positive and negative impact. So the first we want to talk about positive impact of earning management. They are provide this positive signal to the market or signaling, stabilizes earning reports or reducing earning volatility, and the last it helps meet internal company targets. And the negative impact of earning management, such as misleads user of financial statement, reduces the quality of accounting information, and the last is can lead to fraud or ethical violation. It is about regulation related to earning management. Several standards and regulations are related to earning management, including the first is PSAK or Indonesian Financial Accounting Standard, the second is IFRS or International Financial Reporting Standards, and the last is OJK and IDX regulation for public companies. So these standards aim to limit the scope of earning management by ensuring the fair and transparent presentation of financial statements.
Okay, I will explain about income smoothing. Income smoothing refers to a managerial strategy that involves manipulating the timing of revenue and expense recognition or using the flexibility allowed by accounting standard in order to make report income appear more stable and consistent from one period to another. The main objective is to reduce income fluctuation and provide a picture of financial stability to external parties such as investors, creditors, and analysts. Next is Gordon's theory on income smoothing. Gordon's proposition explains that managerial decisions in choosing accounting principles are influenced by their aim to maximize personal utility or benefit. Gordon presents the following key points. The main criterion for management in selecting accounting principle is to maximize its welfare or utility. Next is management's utility increase if job security is maintained, their personal income grows steadily, the company's size and growth increase. Next is achieving these management goals depends on shareholder satisfaction, which typically depends on the company's performance. And shareholder satisfaction increases when the company shows a steady growth rate in income. Next material is motivation for income smoothing. According to researchers such as Hayward and Beitelman, several motivations drive management to apply income smoothing. A is maintaining external relationship, or Hayward. Investors prefer firms with stable earnings. Creditors are more confident in lending to firms that show consistent performance. Employees feel more secure when the company displays financial stability. D is psychological and strategic reason, or Beitelman. A stable income stream supports stable dividends, which increases investor confidence and firm value. Smoothing reduces the cyclical nature of income, lowering the firm's perceived market risk. Next is constraint in implementing income smoothing. Despite the strategy advantage, some barriers and limitations may restrict management's ability to apply income smoothing. A is competitive market mechanism. Companies must adhere to generally accepted accounting principles such as GAAP or IFRS. Competitive pressure demands transparency and accountability. B is management compensation schemes. If bonuses are directly tied to net income, managers may be more motivated to increase income rather than stabilize it, creating a potential conflict. C is threat of managerial displacement. If financial manipulation is discovered, management may lose stakeholder lose, or even face dismissal. The last material from me is dimension of income smoothing practice. Bernie, Ronan, and Sadan distinguish three main forms of income smoothing. The first one is smoothing through event occurrence and or recognition, accelerating or delaying revenue or expense recognition. Example, postponing the recognition of a large sale to the next period to avoid an income spike in the current year. B is smoothing through allocation over time, spreading expenses over multiple periods using accounting methods such as depreciation and amortization. The goal is to allocate costs evenly rather than concentrating them in 1 year. And the last is smoothing through classification, classifying certain revenues or expenses into categories that don't directly impact operating income, such as labeling loss as extraordinary items to avoid affecting core profit.
Okay, here we'll explain about accounting paradigm. First, anthropological paradigm. The anthropological paradigm views accounting not only as a technique for recording financial transactions, but as a social and cultural practice that develops in a society. In this perspective, accounting is understood as part of the social structure and value system adopted by a particular community. This means that accounting practices will be strongly influenced by local norms, customs, beliefs, and culture where it is applied. This approach is widely used in qualitative research such as accounting ethnography, which aim to understand how accounting practices are carried out in real life, not just based on theory or standards. For example, in an indigenous community, the recording and reporting of cooperative finance may be done in a way that is not in accordance with formal accounting standards, but is still considered valid because it reflects the value of mutual cooperation and deliberation prevailing in the community. Another example, in a family company, the distribution of business results can be based on family relationship and trust, not formal profit and loss statements. This paradigm helps us see that accounting is contextual and cannot be separated from the culture and social values in which it develops. Second, behavior of the market paradigm. The market behavior paradigm emphasizes on how accounting information is used by market participants in making economic decisions. In this approach, accounting is seen as an information provider that has the power to influence the behavior of investors, financial analysts, creditors, and managers. This paradigm has strong roots in economic and financial theory, especially capital market theory such as the efficient market hypothesis. Studies in this paradigm generally use quantitative approach to analyze market reactions to financial information, such as the effect of earnings report on stock prices. For example, when a company announces an increase in net income, the company's stock price usually increases because it is considered to provide a positive signal to investors. Conversely, the announcement of restatement of financial statement can reduce investor confidence, so the stock price can fall significantly. This paradigm shows that accounting information not only reflects reality, but also has the power to change perception on an economic decision in the market. Third is economic event paradigm. The economic event paradigm focuses on objectively recording and reporting economic events that actually occur in organizations. In this view, accounting is seen as a tool to describe economic reality through a recording process that is systematic, neutral, and free from social influence and market perceptions. This paradigm puts forward the principle that financial statements should reflect the economic substance of transactions, not just legal forms or subjective interpretation. Therefore, this paradigm strongly emphasizes the importance of reliability, accuracy, and precision in recording. For example, when a company purchases a machine worth 1 billion, the transaction should be recorded as a fixed asset in the statement of financial position, regardless of whether the purchase is profitable or not according to market perception. Another example is the recording of depreciation of fixed asset every period. even though there is no cash outflow, because this reflects the decline in the economic value of the asset used. This paradigm is often used in the development of accounting standards that are oriented towards objectively reflecting economic events.
Okay, now I will continue Velisa's explanation about accounting paradigm. The fourth one, there is decision process paradigm. So the decision process paradigm emphasizes the importance of understanding the stages of decision making rather than just focusing on the end result. This approach views that good decisions are born from a systematical process, starting from problem identification, searching for alternative solution, evaluating this option, to selecting the final decision that is considered the most optimal. In an organizational context, this paradigm is often used to design information systems or policies that support rational decision making. For example, when a company wants to adopt a new technology, management will follow a series of analytical stages to ensure the decision is based on thorough data and considerations. And then the fifth, there is ideal income paradigm. So the ideal income paradigm comes from the fields of economics and accounting that see income as the change in the net worth over a period, rather than simply the result of operating activities. Ideal income reflects an overall increase in economic capability, both from business activity and changes in the value of asset owned. This paradigm is often used in the context of long-term economic performance measurement that is more comprehensive than the conventional earnings approach. For example, if the market value of a company's asset increases from 10 billion to 12 billion in 1 year, then the company's ideal revenue is 2 billion, even though no sales transactions have taken place. Okay, let's move to the sixth paradigm. So the sixth paradigm is about the information economics paradigm. This paradigm emphasizes the important role of information in the economic and decision-making process. The main focus of this approach is how information is obtained, processed, and utilized, and how information imbalances between the parties involved can affect the outcome of a decision or transaction. This paradigm is widely applied in the fields of insurance, investment, and risk management. For example, in the insurance industry, companies often do not know the risk level of prospective customers accurately, so that individuals with high risk are more likely to buy policies, which in turn can harm insurance companies. So the last paradigm, which is the seventh paradigm, is user behavior paradigm. This paradigm focuses on the behavior of information users, specifically how they receive, interpret, and use information in decision making. This approach considers the psychological factors, background, needs, and preference of information users, and in practice, this paradigm is widely used in the design of information systems and financial reporting to make them more relevant and understandable for users. For example, retail investors may focus more on net income as a key indicator of company performance, while institutional investors pay more attention to cash flow and financial ratios. Although they assess the same financial statements, their behavioral patterns in interpreting the information can be very different.